Hello guys, thanks for enrolling for this course. You've made the first step into the beautiful field of finance. You're starting this course as an apprentice, but by the time this course is complete, you're going to be an expert. So without further ado, let's get started. The first topic which we're going to cover in this course, I am very excited. I hope you guys have the same energy as me, because throughout this whole course, this is the energy at which I'm going to teach you. So I'm very excited to do this. The first thing which we're going to learn is types of markets. There are two types of market in the stock market: a primary market and a secondary market, guys. To make you understand this in a better way, I'm going to take an example. So there are two people involved in this, and one is me. So my name is Siddhant, so I'm going to using a short form for this, Sid. And since I don't know you, I'm going to take your initial to be X. Now we own a company named XYZ Limited. And we both own 50% stake in that company. We both own 50% stake in that company. How do I come up to this figure of 50%? Well guys, at the initial stages of forming a partnership, it's quite evident that you and me both invested some sort of a capital in the company, XYZ Limited. We both invested some sort of a capital which was equal, and along with that, any sort of assets which were being brought in the company, we both were equal owner of that. We both invested the same amount of capital and we both invested the same amount of asset, and that's why we both are 50-50% partner in our company. Now what happens is, we are making good amount of profits. We are making 100 crores an year, which is a very huge profit. You come up to me one day and you're like, you know what, I have an expansion plan. If we can invest 200 crores in our company, in the next 2 years, we will be making profits close to 500 crores. Sounds like a good deal, right? Investing 200 crores, working hard, and then after 2 years, reaping the rewards of earning profit worth rupees 500 crores. How is that not wonderful? Sounds like a great opportunity, but I raised a question. I was like, okay, where are you going to acquire these 200 crores? Because the profit that we are making, we are reinvesting it in the business, and we are taking some of it for our personal livelihood. So we are taking some to our home and fulfilling our needs and stuff like that. So we don't have that much amount of money. We don't have 200 crores. What do you have in mind? So the first thing which comes to our mind is raising a loan. We can simply go to a market, or as we say in the field of finance, in the world of finance, debt. So we can simply go and raise a loan. We can ask for the bank to give us 200 crore rupees, and after that, returning the principal and interest amount on regular intervals, we're gonna get rid of our loan and we will enjoy the beautiful fruit of 500 crore rupees. Sounds like a very good deal, a lucrative deal. But the issue with raising a loan is, you have to present a collateral, guys. You have to present a collateral, which basically means you have to provide a security to the bank. That is, for raising loan, you have to provide them a security. The issue with that is, in India, let's say that the value of your property is 200 crore. The bank will only give you a loan of worth rupees 160 crores, or 80% of the value of the collateral. 80% or less. They won't be giving you a loan more than 80%. That's the basic rule followed by every banker in India. So the first hindrance which comes in raising a loan is, we have to provide a collateral whose 80% is 200 crore rupees. Yes or no? Since I want to raise 200 crore, so I have to provide a collateral whose 80% of X, that is the value of the collateral, or even less, is 200 crore. And let's say that you and I don't have that collateral. We don't have a value of property, as a matter of fact, or an asset whose worth is 200 crore rupees. What to do about that? That sounds like a reasonable argument for not raising loan. The other thing is that even if we have a collateral to present to the bank and we raise a loan, what happens is we have to provide with regular principal and interest, that too at regular intervals to the bank, irrespective of what we are doing. If we are in deep loss making position, we are making huge amount of losses before making this 500 crore rupees, we are making losses in our business, even after that we have to ensure that the payment towards the bank goes. That's an added pressure to your business if you are not going to take that. If in the next 2 years I'm going to be profitable, in the next year I'm not going to be profitable, then this is going to cause unnecessary pressure on me and my business. So I'm against raising a loan. What is the other option that we have? What is the other option that we have? Let me remove all of this so that it does not cause a confusion. Also, this whiteboard is really fun to use. Let's be very honest. This is a whiteboard which you can actually download from the net. It's free of cost and it's so beautiful to use. Yes or no? Okay. So now 200 crores we need. So what we are going to do is, let's say that every big company, right? They have investment banks associated with them and they act as a consultant, guys. They act as a consultant to your business. So me and you, we approached our investment bank, and our investment bank was Goldman Sachs. So we went to that investment bank and we had a discussion with them that we want to raise 200 crore. So they gave us a suggestion. They simply said, let go of some of the ownership in our company. I was like, what do you mean by that? They said, let go of 10% in your company, Siddhant. And your name, X, let go of 10% in your company as well, which basically means that you are now going to be left with only 40%. You're now the 40% owner of your company. Remaining 20%, distribute it among the common general public. They would want an ownership in your company. They would want an ownership in your company, and in return, they will provide you with the money that you need. Sounds like a very beautiful thing. This whole scenario is known as an IPO, guys. That's the basic thing, and I wanted to start this lecture on an IPO. Initial public offering, which basically means that raising funds from the public, guys. That is asking for funds and providing them with the ownership in your company. So basically you're making 20% owner in your company, the common public, guys, the common public, and you get to keep 40% each. You and me get to keep 40% in this company named XYZ Limited. Now, IPO seems like a very hectic process, right? Well, you don't have to worry about that. The investment bank, in this case Goldman Sachs, will carry out the whole process of issuing the first public offering. You don't have to do anything about that. You don't actually have to do anything about that. They will figure out the prices, they will find out the number of shares which are required to be issued, they will see if they're oversubscribed, undersubscribed, everything they will do. You actually don't have to worry about anything. You just have to sit and provide them with the fees. Of course, that fees is going to be huge, but at the same time, the burden is off your shoulders. And they are actually an expert in this field. So you are basically giving experts control over this. All of this, the initial public process wherein people will come and take stake in your company by providing you the money, happens in primary market, guys. Happens in primary market. The IPOs are being issued in primary market. You must have seen that recently Burger King also launched their IPO. All of that happened in the primary market. To acquire the IPO of any company in primary market, you have to fill out a form stating the quantity that you want, the number of shares that you want, and every other single detail you also need to provide. Your demat account, everything you need to provide. It's not the regular trading which happens in the market. If you're not aware of what trading is, don't worry about it. We're going to cover that as well. So this is not your regular market. You have to fill out a form and everything. So this is known as your primary market, where the IPO is being issued in the market. Okay. Once this is done, let's say that IPO was very successful. You were able to raise 200 crores. Good for you. Yay for you. And now, one added thing in IPO is that there is no unnecessary pressure. Since they are the owner of the company and you decide if you want to share the profits with them in the form of dividends, you actually don't have any sort of burden on your shoulders. You can take the decision. Of course, you have to include them in the decision-making process. But at the same time, you actually don't have to provide them with the profits if you don't want. Let's say that the company makes a profit of 500 crores. Out of these 500 crores, they believe that 400 crores needs to be reinvested in the company. 400 crores needs to be reinvested in the company. So they can take that decision. The board of directors, the owners can take this decision, and they will not be giving you dividends. So it's a very freeing sort of a way of raising money. Okay, so this all of this scenario which is happening happens in the primary market. Once you're done with that, once people acquire the share of your company, let's say that they acquire the share of your company at a price of 100 rupees, and a person, let's say that a person named Y acquired your share for 100 rupees and the quantity was 500, which means that he paid a price of 50,000. He paid a price of 50,000. Later on, what happens is your company performs really well in the stock market and the prices goes to 120, which means 100 of 20 into 500, which comes to 60,000, which means that you made an initial profit of 10,000. You made an initial profit of 10,000. So, and you are satisfied with that profit, not problem. You're satisfied with that profit, which means that in this case Y will sell this share to someone else. That selling will happen in the secondary market. This is where the actual buying, selling, trading, investing happens. All of this is happening in the secondary market, guys. All of this is happening in the secondary market. This is the place where you buy and sell actual shares. You trade between each other. A person who wants to sell and the person who wants to buy will meet, will enter into a trade, will enter into an agreement, and all of the action which happens in the secondary market. Now let's go and look at the PPT. Let's look at the definition. Let's look at the points, and let's end the first session, guys. I hope this was very exciting because it was for sure very intriguing for me. Okay, guys. So stock markets in India. As you know, there are two major stock exchanges in India, Bombay Stock Exchange and National Stock Exchange. Even if you haven't heard of them, by the end of this class, this is going to become a place which you will frequently visit. That's my guarantee to you. You will trade, you will invest, so you will visit these two markets. If you've heard of them, perfectly great. Okay, guys. Now, let's look at them in general. So primary share market, this is the market where companies or businesses register themselves. What do this register themselves mean? This basically means, guys, listed in the exchange. Listed in the exchange, guys. Which means that they are listed in Bombay Stock Exchange or National Stock Exchange. They even get delisted here. The example of delisted company, Kingfisher, guys. Go and check. You won't be able to find anything related to Kingfisher in the market now. Companies enter the primary share market to raise funds by offering their stocks. They're offering their stocks to common public. When a company registers itself on a primary share market and offers to sell its share for the first time, it's known as initial public offering. I hope this is clear to everyone. We did a very good example on this. Here, you must understand that the share are a physical representation of a small value of the company, and owning share means that you are a part owner of that company. How great is that? So, so in my portfolio, I have purchased shares of Reliance. I guess they are 25 in quantity. So that makes me the owner of Reliance by those 25 shares. Do you not think that's a very great thing? A good feeling? I hope you are as energetic as I am, because this particular course is going to be amazing, guys. I have no words for this course. Although, since I've made it, I'm sort of praising myself. So yeah. Okay. Secondary share market. The actual trading of companies' share occurs in the secondary market. Like I said, the buying and selling, the actual buying and selling between you, me, thousands, crores of other people happen in the secondary share market. After a company's share are listed on a stock exchange, investors can engage in trading. That is, sale or purchase of stock on prices that are governed by the market movement. Here, like we read in the previous example, that we did, that the investment bank is basically setting the prices. Right. In this case, the prices are being set by market movements, which basically means the prices are being set by your friends, demand and supply. In stock market and economics, these are the two most important things to learn: demand and supply. अगर कोई बहुत ज़्यादा खरीद रहा है एक particular share को, and if someone is selling that share then there is demand and supply in the market. अगर किसी शेयर को बहुत सारे लोग खरीद रहे, if a particular share is being purchased by a huge number of people, then you say that the demand of that particular share is very high. If people actually want to buy that share, if there is huge amount of share in the particular market for selling, but people are actually not buying, then we say that the supply is very high. You can trade in shares in the secondary market only through a broker. Your broker, what do I mean by this? A person who acts as an intermediary between the stock market and me. Example, Zerodha, Upstocks. These are the brokers, guys. They will act as an intermediary between you and the stock exchange. That is it for the first class. I hope this is clear to everyone and you enjoyed this. Let's move on to the next session, guys.